Welcome to No Nonsense Nonprofits. Hi, I'm Sandy Ray, founder of Sandra E. Ray CPA, where we alleviate financial headaches so that you can create a bigger impact. Today, we're taking a deep dive into the Form 990 compensation reporting, and that's on Part 7 and Schedule L. Form 990 is more than just reporting financial results. It's a public disclosure document that regulators, donors, journalists, and watchdog organizations review on a routine basis. The two sections that consistently raise questions and risk are Part 7 about compensation and Part L on transactions with interested persons. Today, we're going to focus on how these sections work together and where you as an organization may get tripped up. So let's start with why Part 7 and Schedule L matter. Both of them highlight how we govern our organizations. Part 7 tells the public who leads the organization and how they're compensated. Well, Schedule L reveals financial relationships that could create conflicts. Together, they answer three questions from key stakeholders, and they are: who is in control? How are insiders receiving financial benefits? And are transactions reasonable, disclosed, and approved? So we really want to talk about how these are closely related and reviewed by regulators, again, watchdog organizations, donors, and journalists. And so our reputation is at stake, and transparency is key. And that's really what we're going to be talking about today. So let's dive into Section 7 a little bit more in detail. Now, Section A lists the individuals with authority or influence over the organization. And these people are our officers, our directors, our trustees, our key employees, our highest compensated employees, and then, of course, former officers, directors, and key employees, and anyone involved in the period that we're reporting on for the 990. Those people have to be reported on that Part A of Section 7. So for each individual, we are going to disclose their title, the average hours per week that they've worked, whether that was on a paid basis or a volunteer basis, and we're talking average, the compensation from the organization, the compensation from a related party to our organization. And when we're talking about compensation, we're talking about reportable compensation, for example, W-2 compensation or compensation on a 1099, but then other compensation like deferred compensation, our retirement programs, and then, of course, benefits that are paid out. So those kinds of things are going on Part 7, Section A. And I just wanted to make sure that everyone understands that titles don't really determine the inclusion of who goes on the schedule. It's the authority and compensation levels. So be very careful. I want you to understand that any employee can be included here if their income is $150,000 or more. So let's move on to Schedule L. This is transactions with interested persons. And it expands the transparency that we started in Section 7, and it goes beyond payroll. It discloses transactions between the organization. And again, we're talking about transactions with officers, directors, key employees, highly compensated employees, their family members, their businesses, their business partners. These are the types of interested people that are going to be reported on Schedule L. And Schedule L has 4 distinct sections. The first part is excess benefit transactions. The second part is loans to or from interested parties. The third part is grants or assistance to interested persons. And finally, the fourth part, business transactions over certain reporting thresholds. And there's lots of reporting thresholds, but generally Think of a cumulative payout to an interested party of $100,000 or more in a single year, or a single transaction of $10,000 or more, or 1% of your total revenue. So Schedule L is really not about wrongdoing. It's about disclosure and transparency. I wanted to make that clear before we get into the details. So let's talk about who the interested parties are. And again, interested parties include the current and former officers, directors, trustees, or key employees, their family members, such as a spouse, a parent, a child, or a sibling, and entities where they have significant ownership or control. And then, of course, those business partners as individuals. This is really a bigger definition of interested employees than most executive directors expect. And another common misconception is that if the transaction is at arm's length, it doesn't need to be reported. Definitely, the transaction needs to be at arm's length, and definitely it needs to be reported. There are some thresholds that we might not meet where it's not reported, but I think you have to look at these transactions as they're reportable and then go look at the instructions for where these thresholds fall. So common transactions that can trigger a Schedule L reporting, they're consulting or professional services paid to board members. Maybe a board member is an attorney, maybe a board member is an accountant, maybe your board member is a plumber, whatever those professional services are. Real estate leases involving insiders of our organization. So many times we might have a founder who is leasing a space. So those kinds of things have to be reported. Payments to businesses owned by officers or their family members. So maybe you have a board member whose spouse owns a cleaning company, and that cleaning company is doing the work for you. That has to be disclosed. Any expense reimbursements outside an accountable plan. And what they mean by that, an accountable plan is an IRS accountable plan, which basically means expense reimbursements are supported by receipts. So anything outside of that, if it's significant, will have to be reported. And then, of course, any loans to or from the organization, regardless of whether interest is charged or not. So those are the types of transactions. Now, to those transactions, there are various different thresholds, and they vary by transaction type. But once you meet that threshold, then disclosure is mandatory. And reasonableness alone, if you think this is a reasonable transaction, that does not eliminate it from reporting. What we're doing is trying to be very transparent with those stakeholders, and that this transaction is reasonable, but it is with somebody who has influence over our organization, and we want to be very clear about that and explain it. Now that we've talked about both schedules, let's talk about aligning both schedules so that it doesn't cause any red flags when you're preparing your 990. It's really critical that there's consistency across both parts of the 990. So individuals listed on Part 7 often appear on Schedule L, and generally people listed on Schedule L are on Part 7. Compensation disclosures must align for those people, and related organization payments may affect both sections. So a big red flag for these two schedules is really, who are we listing and is there consistency? If you've got somebody on Schedule L who's not on Part 7, that is a big red flag, and you're going to want to review your 990 to make sure that doesn't happen. So that brings us to our risks, our potential errors, and as a result of those potential errors, some best practices that I would recommend. So let's talk about the risks and potential errors. Number one is omitting a business transaction involving an insider, just not including it on the 990 at all. Underestimating who qualifies as an interested party. I think I encourage you to read the instructions on who qualifies. They get very detailed. Once you understand who qualifies, failing to track family member relationships of your interested parties. That can be Sometimes it's really easy. They have the same last name, you ask the question, but you really need to have that information in order to make sure you're tracking these transactions properly. And then not disclosing the transactions or disclosing them inconsistently between Part 7 and Schedule L. So best practices of a course would be number one, maintain your annual conflict of interest disclosures. On those disclosures, ask specifically about family-owned businesses. Track your insider transactions throughout the year. Don't wait until filing time and trying to figure it out and be rushed. When you are filing your 990, look at Part 7 and Schedule L together, not in isolation. You want to make sure there's consistency in what you're reporting on both schedules. And then for complex relationships, or if you have questions, engage an experienced nonprofit advisor to help you with those. So to summarize what we talked about today, Part 7 and Schedule L are central to governance transparency for organizations, IRS compliance, and public trust and our reputations. Executives like you don't need to manage all the technical rules, but you must understand the insider relationships in your organization and that they are identified. What transactions are happening? Are they reviewed? Are they approved? And are they documented in your board of directors minutes? Are those involved people recused from the discussion? That's important too, and documented. And that your disclosures on your 990 are complete and consistent. So I encourage you to review your conflict of interest policy and disclosures. Inventory any transactions with insiders on a regular basis, at least annually. When preparing your 990, make sure you're reviewing Part 7 and Schedule L together before you're filing. And again, consult an expert nonprofit advisor for those high-risk arrangements. I hope this was helpful for you today. And if you have any questions on this or other topics, please put it in the comment section below. We always appreciate your likes, and I want to thank you for joining me today. Remember, creating a bigger impact starts with stopping the nonsense. If you're dealing with nonsense in your nonprofit organization, we'd love to help you cut through the noise.